Nasdaq and the S&P 500 close at all-time highs. Donald Trump out with a big congratulations. Meanwhile, the put-to-call ratio is at its lowest point in decades. Complacency at its finest, people. You're watching the Daily Stock Market Brief. My name is Michael Silva. Today's date is December 8th. In today's video, we're going to be using technical analysis to get a good idea as to where the market might be headed next. Let's get into it. All right, welcome back. We're going to start off with the S&P 500 on the daily time frame, and then we're going to go to the 30-minute time frame. Yesterday's video was all about talking about what I've been noticing on these 30-minute time frames of the market continuing to coil up tighter and tighter and kind of drifting higher slowly but surely, not quite consolidating. On the daily time frame, what did we see happen today? Well, it's very simple. We opened down here. Where was that at? The 5 EMA moved just a tad bit lower and then ramped up, jammed up higher throughout the rest of the day. What have we been saying? The 5 EMA on these daily time frames have been holding as very, very strong support. And when the market falls below it, it hasn't, it has very well struggled to stay below it for multiple days. As you can see here, it came down, closed below it, but really just for a quick, short period of time before ramping up higher. We recently are, broke above this ascending type triangle, or you can call it a symmetrical triangle, and we're kind of jammed up here at the upper range of the Bollinger Band, pushing over 3,700 for the first time. What do you know? Pretty rad, pretty crazy. Then on the 30-minute time frame, these are the more in-depth for more short-term trading. What I like about this right here is it's just been in this strong, solid channel. And what I've been noticing is the RSI is kind of losing some steam momentum, but the price continues to press higher and higher. So there's a couple of things that can happen. One, you can see from this little dash line here, it's somewhat of a rising wedge pattern within this channel. Lately, typically what you see is it coming bounce back and forth and kind of trending up, but it's been holding this top level here, which, putting in these higher lows, higher highs, it would be nicer to me if this was consolidating more sideways and then we ramp up higher. That still could be what it's technically doing here. We might pull back to 3680 and bounce around 3700 and then continue that move sideways. Or we might just continue this Santa Claus rally and continue to press higher. The bulls are still in control at this particular moment. If we start breaking down through this, maybe we might see some of these gaps right down here filled, potentially hit this lower range right here, but we will see in the very near future. Let's look at the Dow Jones. Dow Jones continues to coil up within this pattern. What took place today? Well, we gapped down below the 5 EMA, quickly rebounded, tested the upper portion of this trend line, and then just got jammed down just very slightly. All right, so we're still holding above the 5 EMA. The 5 EMA is kind of flattening out very subtly. You can see the MACD just flat to sideways right here. It looks like it's about to cross over, but we don't know necessarily if that's going to happen. Overall bullish context, these gray shaded boxes are just gaps that push the market higher and higher, setting itself up for a very, very strong potential of a rug to be pulled out from beneath our feet. So you need to make sure that if you are in long positions, that you are taking profits. You're not YOLOing a bunch of calls, because you might wake up one day and just have this massive gap down and just continuous selling. Lately, I didn't mention it on the S&P 500, but on the SPY chart, as we're continuing to make these new highs, we're doing so on pretty weak volume, so it's something to consider. Now, here's the Dow Jones on the 30-minute time frame. You got that rising wedge. You can see the more structure of it, more candlesticks, negative divergence on the RSI, negative divergence on the MACD. You see all these gaps. Maybe we ping pong around here a little bit longer, or maybe we just burst above this trend line and just catch some more breath. We will see. Russell 2000. Russell 2000 is just the shining star of the indices right now. Small caps have been really making a big move. What happened? Well, we gapped down and then we immediately ramped up from that 5 EMA. The 5 EMA has been the key just support level for this entire move since early November. Now, the RSI, very frothy. Where are we? Well, we're at this upper trend line, and we're at the upper range of the Bollinger Band, and we built this move up with a lot of gaps beneath us. So what can we look for as far as weakness? It'd be nice to see a big gap up and then it close red on the day, potentially a small gap up and even close red below the 5 EMA, which would signal, a lot of weakness coming into the market. And even on the 2-hour time frame, you can see this rising wedge structure that is just almost straight up in the air, negative divergence. You can see all these gaps. this right here is just not a structurally sound for a market move. You need to see some more types of consolidations and then moves up. You typically, when you zoom out and you see, long-term patterns, you see moves up, you see sideways action, maybe a little bit drop off, and then continue that kind of 4-step little bridge approach or whatever you want to call it. And then we got the 30-minute time frame. Really quick here, I posted out on Twitter earlier today that I was hedging short right here at the very top. I got I think about 10 cents higher than this, so I hit the top today. It really just kind of stayed around there for the remainder of the day. But the reason why I got up there, even though on all this strength, is simply because there was a negative divergence on both the MACD RSI. We're at the upper range of this trend line. Figured, hey, why not take a stab at hedging some long positions right here at this particular point in time. If we start breaking above that, I'll just get stopped out and then potentially reposition at signs of weakness or overextensions, and I'll just fade into that. Let's look at the Nasdaq. Nasdaq 100, another record day. It's been making record days pretty much. Let's just see. So today, another day. Pretty much that day, a close at least. It hit a high that day and a close, I think. This day, yeah. So like 4 or 5 days or something like that. Of pretty much just as soon as it broke out, we're just seeing records very, very consistently. That's not necessarily normal market behavior, is to always get new records. And in the conclusion, I'll kind of wrap your head around how the normal person would feel if they don't quite understand the movements of the markets, etc. But yeah, very strong. What can you do here? Well, you got to look for areas of pullback or consolidation and then buy into the strength that comes from those areas. So yeah, it seems like for the rest of the year, it seems like this is a buy the dip sort of market. When it comes down, people buy right into that weakness, and then it becomes shortly thereafter strength. This is on the 30-minute time frame. You have a rising wedge. This was the one that I was pointing out yesterday. It looked like it was going to break down. We had that gap down. We closed, got below it, but quickly then, when it found its support right around 12,500 for the remainder, it just kept on ramping up 30 minutes after 30 minutes after 30 minutes for the, base of the entire day. And then at the very top of this channel, we saw some weakness again. So I just kept that there just to see. You can see these new highs are being made on less and less, or basically I should say negative divergence on the RSI, so less strength. Now it's time to look at some indicators. Let's do that. Here is the percent of stocks above the 200 period moving average in the S&P 500, and then we have above 50 period moving average. So 81.36% of the stocks are above the 50 period. But what I wanted to point out here is a more longer term basis. Because of this aggressive move up, which we've been calling out multiple times, 91.38 is where we're at now, which means 91.38% of the stocks are above the 200 period moving average. Just look back in history, the last times I hit 90%, far and few between, but like the last time was here in mid 2014, and when it reaches these levels and it turns down from those levels, you can see some pullbacks. So I marked those out here. You can see 9%, 5%, 7%, 16%, 20%, 6%, 8% drops. These type of, even a 10% drop at these specific levels. Not saying that it can do that right now at this particular point in time, but it is set up to do so. And a 10% drop would really fill the majority of those gaps that we saw on the ramp up in November. Something to keep in mind. Now, yes, most of my signal charts and indicators are all jammed up to the max overbought. And then you look at sentiment, and sentiment too. I mean, just look at the NIAM exposure index. What are asset managers doing with their money? They're max long right here. Then you have the RIDEX right below it. It hasn't been this bullish for quite some time. So this is real money. So it just seems like a very, very complacent market, very, very bullish. Maybe maybe everybody knows something and that the market's going to keep continuing to go up. But from, the past, just looking at charts, when you typically get this euphoric behavior, what typically takes place at some point shortly after is you see moves to the downside. Same thing, with the RIDEX, when it reaches these very, very bullish extremes, you can see pullbacks, and the NIAM exposure as well. Now, the NI high low jammed up 98.43. When it reaches these levels, sometimes you get some pretty aggressive pullbacks. Notice the velocity of the move to the upside, and we're just holding these levels just jammed up there. So pretty intense. The BPNDX is still not overbought, but just let's call it as it is. That's a negative divergence. The NDX keeps on running higher and higher, but it's doing so on just relative weak strength here. And then the same thing goes with the SPX, or the BPSPX, which is the bullish percent index. So basically what it's saying here is 77% of the stocks in the S&P 500 are on buy signals based on these point and figure charts. Negative divergence, so it's making market highs on just less strength in the market. And then we have the CPC, smooth over 10 period moving average, the total put to call ratio. As mentioned, this is the lowest it's been in pretty much decades. So this is the total put to call ratio, and this is smooth over a 10 period moving average. So very complacent. Everyone is very, very bullish extremes at this particular point in time. And here's the Nasdaq new high low. I brought this in quite some time ago, but some people have been talking about this chart again. Just want to point out the levels that it's at right now. The last time we were at these levels was basically right around end of January going into February here at these particular highs. Now, that doesn't mean that we're going to see this, massive drop off by any means, but what it does show you is we made these super highs, from a market low here, and then we made a higher high here on the composite, but it did so on a lower reading on the index, so it created a negative divergence. And what we're seeing here is this move up, maybe potentially in the future going into 2021, if this Santa Claus rally or this holiday rally continues, maybe it might do so or consolidate and then ramp up higher, and then we would have a negative divergence here as well. So another thing to consider moving into the end of the year, if stocks keep continuing to ramp up, is to watch the new high-low on the Nasdaq. Now let's talk about the commodities. This is the CRB index. This is just a basket of commodities. In short, when the index moves up, demand for those commodities increases and or the supply, in theory, decreases. This really works inverse to the dollar, and I'll be getting into that here shortly, but I wanted to point this out. It has now traded 2 days below the 5 EMA. Last time it actually did that for 2 days after a nice consecutive run above it, we saw a 6% drop in this specific index. Now, what we've been seeing recently is the dollar declining, and the dollar has been declining into an area of support. Meanwhile, the CRB is running into an area of resistance. Now, right around 154 to 155, this resistant level right here, I didn't draw it out. From the March crash, February crash, to the March low, I should say, that right there is the 61.8% retracement level. So we recently broke out above it, and we got this squeeze higher. So it's potentially possible that we come back to backtest that area, or this might just be consolidating sideways to down just slightly, creating a bull flag to have another ramp higher, which would indicate still more inflationary pressure coming in to the markets. And we can look at multiple different aspects for that, but on this specific chart, I wanted to just point out, on this specific chart, I just wanted to point out the MACD is crossing itself over. That's a bearish crossover. We did get under the 5 EMA. Potentially this move might have some legs to the downside before it catches. I did also find it interesting when I'm looking at gold, is gold has been sinking down since basically August, but when you look over through here, you've been seeing the CRB, the broader range index, kind of floating upwards, and they typically move hand in hand together for the most part. So that I found to be quite interesting. Gold here today is, up $8, up 0.5%, solid move to the upside. Like I've been saying, I don't necessarily believe this move. One, because I'm pointing out the CRB index crossing below the 5 EMA. It might be a bull flag, so it might be good. But then two, the dollar is running into support. And then three, when we're looking at gold chart right here, this is the 50 period moving average aligned with the confluence of this upper trend line. And then we have this upper trend line right here above us as well. So, was this the bottom, or is this just kind of a bounce that's going to create a lower high and then potentially move lower to the downside? It's very possible to see this broken out, and this could just be a fake little dead cat bounce until further notice. So we need to be very careful here. If you are buying gold, it would be a lot nicer to see it move above these levels and then consolidate sideways more, and or make more of a cupping type pattern and then potentially break out higher. So you just need to be overall very careful at this specific level with gold. And then you look at silver, look at the upper trend line here, tagged it pretty much perfectly, and then created an inverted type hammer candle. Yeah, we're still above the 50 period moving average, but it looks like, previous times it did that, boom, we fell to the downside. And then, this pattern right here is a descending triangle. So we need to take note, if we start breaking below this level, we can head lower. MACD is still turned up, running into resistance. We'll see here. Then Bitcoin, I pointed out this ascending triangle the other day and basically said if it broke below it, it's very possible to hit this 50-period moving average target area right around 6,500. So I just drew out a pink box to potentially see where it might pull down to if people are trying to buy into it. It made an all-time high on a negative divergence for whatever that's worth. And then you have the MACD turning down right here as well. So pretty big down day. I mean, down 4.18%, but this is very volatile, so it can, make moves very quickly. Let's look at dollar. The dollar broke through 92. That's when we started seeing weakness. And these last few days, we're seeing some higher lows on the wicks, and we're seeing the MACD slowly turn up. The RSI is coming out of that oversold territory and is kind of moving up here as well. Is this going to be bouncing up potentially to backtest 92 or potentially move higher? It's very possible because this area happens to be somewhat of a level of support. Now, we don't know if this is going to be just a little dead cat bounce to potentially head lower or not, but on the weekly time frame, I've drew out since basically early 2020, a falling wedge, which is bullish. We have a positive divergence here, and we can still take a lot of time for this to potentially play out. But notice how it's making new lows in the US dollar here, in this US dollar index, but it's doing so on stronger strength here. So, the price action's down, but this is telling us something both in the MACD and the RSI. So it's very possible that we break out of this like we did in 2017 to 18, and then we make another high. Now, notice also where the price action is coming down to is this level area of support. So we have the CRB index, like I kind of mentioned, running into an area of resistance, which is up here. So this is the CRB, 170 to 160, this kind of range up here. And then you have the US dollar falling down into that level of support. And notice how CRB is going up, US dollar is going down. They work inverse with one another, and sometimes these could diverge for quite some time before you see movements in the other direction. Now let's take a look at bonds. We'll look at the TLH, this is the 10 to 20-year bond ETF, and we've been just kind of pointing out this channel that it's been in, hit the low portion. Now we're starting to see it bounce up again. When this TLH goes higher, yields go lower. So just by looking at this, you can know that yields dropped a little bit today. Here's the yields. We have the spread of the 10-2 and the 30-5 both increasing. Yeah, we had a down day on the 30-year, 1.18 down, and then the 10-year as well down, the 5-year. So, but this doesn't really necessarily mean too much to me right now at this particular point in time. What I want to point out is the trend still continues to put in higher lows, and we're coming from a period of falling rates. So yeah, while these interest rates that are rising might be viewed as bearish for stocks, rising rates after a period of declining or sharp declining interest rates typically mean that we're seeing a strengthening economy, which could be positive for stocks, and we're seeing that take place right now. However, just know that really falling interest rates are viewed as bullish for stocks too, but falling rates after a period of advancing rates indicates a potential weakening economy. So if we see this spread continue to go and build, and yes, this is a relatively low, continuous rising rates could end up being quite negative over the course of time for the equity market. So yeah, we have the spread continuing to increase. They're pricing in future growth, future inflation in the markets. We're going to just kind of keep an eye on the bond market, see what's really, if there's anything that really takes place. We're still below 1.0. Maybe we get above that and we start pushing significantly higher. But, this is just showing us a trend. It's not really predicting what could very well take place next. Another thing that I want to just really quickly point out is these short-term rates. When these short-term yields are super high, it attracts money to low-risk investments. When they're really low like they are right now, it attracts high-risk investments. Why would anybody want to save money when rates are so low? And then also when you look at long-term yields, when they're high, it makes borrowing more expensive. So yeah, that's good for the banks because they lend out the money. They borrow short term, then they lend out long term. But a very high 30-year, 10-year, these high yields, it applies pressure over the course of time. Now, like I said, they're still relatively low, But the higher that these go, it makes borrowing money more expensive, which puts a drag on the economy. All right, let's wrap up the concluding thoughts. Overall, market is still pressing forward quite strongly. It looks to me, and it's very hard to argue otherwise, that the market is extremely overextended at this particular point in time, extremely complacent. You can see so in sentiment, you can see so in certain charts, etc., etc. So what does that mean? Well, I'll tell you first what it doesn't mean. It doesn't mean necessarily that there's going to be a stock market crash or the bubble's going to burst. But from a technical standpoint, what it means is you can have sharp corrections at any given time. So one news headline could really send the market down significantly in a very, very quick period. I always go back to telling people, look at the March or February crash. It literally went down in 3 or 4 weeks. It went down as low as the previous high from 4 years ago. So in 3 or 4 weeks, it came down to a level that was, seen 4 years ago. Then obviously the Fed introduced just crazy amounts, insane monetary policy. You saw the M1 money supply just ramp up to insane levels. So yeah, what we're seeing right now is a very drugged up market. And can that continue to just ramp up? Could it be like something like we saw in Zimbabwe, where the market just kept on flying high as their currency, their dollar, got just completely obliterated? I mean, maybe, but we are also the world reserve currency. I don't think we need to necessarily worry about that at this particular point in time. But who knows what the consequences of going from $4 trillion to 6.2 or 7 trillion in money supply within a year, going up 55%, which is just absolutely bonkers. So from a trading perspective, what am I doing? I'm hedging my long position with shorting. I already minimized the amount of long positions I have at this current moment, and I plan on getting back in long only at specific pullback levels into major areas of support. But at this particular point in time, I'm just catching little tidbits here and there and then just constantly hedging them out. And once I get stopped out on my hedges, I just reposition them just to make it simple, because I do know that when this market movement, goes vertical, the pullbacks can be just as aggressive and take a lot of people by surprise. That's all I got for you on today's market brief. Everybody have a good day.